Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah, filling in for Samina today. Of course, we'll take some of the queries that you all have given to us during the end of the show. But I think the topic that Samina had chosen to talk about today is a very interesting one. A lot of PMS houses are converting into asset management companies having a mutual fund outfit. And therefore, the debate about whether it is prudent to invest in a portfolio management service with a minimum of 25 or 50 lakhs, as the case may be, versus putting that money in a diversified way into mutual funds. Is that a better option? So a lot of people are now a lot more wealthier, and therefore both of these options would be open. What to choose and why to choose that? Let's talk about that with two experts. We'll start off the conversation with Shantanu Bhargava. He's Managing Director and Head of Listed Investments at Waterfield Advisors. And I'm told Kshitij Mahajan is also with us, Managing Partner and CEO of Complete Circle Wealth Solutions. Both of you gentlemen, thanks so much for taking the time out and being with us. Really appreciate your time. Kshitij, you would be advised, you actually run a PMS as well, you guys, and you of course run a mutual fund advisory business as well. So I'm putting you in a tough spot here, right? What is better and why?
Good afternoon, Neeraj, and good afternoon, Shantanu. And I think this is one topic, which keeps on coming again and again, MF versus mutual fund. MF versus PMS. So, if you ask me, Neeraj, PMS is a very different, basically they both are investment vehicle to achieve your financial goals. That's what it is. PMS is much more customized in terms of its approach when it comes to how it operates. And PMS is mainly meant for HNI plus segment where you have a portfolio of at least minimum portfolio of 4 to 5 CR for any clients. So I think this is not one against another. This actually comes and go hands in hand with each other, depending on what type of client is there, what type of risk appetite he can take, and how much big size the portfolio of the client is. So that's how it works. Mutual fund is much more simpler as a structure. I keep on telling people that I have invested into my PMS as well as mutual funds also. So I have both investments which go hands in hand. But yes, someone who's having a portfolio who want to do a monthly investment through a systematic investment plan, I think mutual fund is a much better tool. Both the strategies have their own pros and cons. Having said that, PMS is more meant for a HNI plus segment, along with the mutual fund what they hold in their portfolio. Mutual fund is meant for people on the retail side, or somebody who doesn't want to get into open a demat account and just want to keep things simple. I think it is meant for those people. And having said that, mutual fund is much more simpler as a tool. It has tax advantages also, vis-a-vis PMS, as it is been treated like a pool. Anything which a fund manager which buys or sell, it comes without any capital gain because it's in pool. While in PMS, whatever transaction you do, it's an individual holding, you end up paying long-term or short-term capital gain depending on the holding of the stocks.
Noted. Okay, and in some sense, a good opener out there. Shantanu, good talking to you for the first time that I'm speaking to you on this platform. How are you thinking about this?
Hi, Neeraj. Thank you. It's good to be here. Good afternoon, everyone. So primarily, PMS as a category was developed to cater to the needs of affluent investors. The goal was actually to allow PMS as a platform more freedom compared to MFs in terms of risk-taking capacity to generate higher returns, at least theoretically. Therefore, the minimum investment threshold is a substantial 50 lakhs compared to a humble 500 in the case of mutual funds. So let me just unpack the two vehicles for the benefit of our viewers. Both the platforms share 4 common key attributes. So basically, you get professional management, you get the benefit of diversification, both offer liquidity, and flexibility to investors. And actually, both the platforms are highly regulated and transparent. Now, let's appreciate the differences in the design of the two product categories. So the first key difference is the regulatory limits that are imposed on the two platforms are very different. So theoretically, again, and I'm underlining this word again because that's where the key challenge with PMS is. So PMS is positioned as a product category for investors who can afford to take higher risk. And this higher risk taking comes by way of relaxed constraints from the regulators. So in the case of equity mutual funds, SEBI has put in place guardrails to protect investors from the risk of overexposure to a single security. So a scheme's portfolio cannot hold more than 10% in single stock. However, in the case of PMSs, there is no such cap on stock level exposure, which permits the PMS manager to express more conviction in a particular security. Additionally, what happens is in the case of PMSs, the second difference essentially is about the approach. So that's the key difference. So most equity mutual fund categories, they strive to outperform their benchmark performance in a relative fashion. So which means that their portfolio construction is largely aligned with that of the underlying benchmarks, with very few outsized variations in stock and sector sizing when compared to the underlying benchmarks, such as Nifty 50 or Nifty 500. While in the case of PMSs, their performance is measured against an underlying benchmark and their peer set, but most true to label PMS products, in theory at least, employ a strategy that involves constructing a very distinctive portfolio, which may deviate significantly from the composition of the underlying benchmark. Let me simplify it by giving you an example. Let's assume we have two fund managers, one, one on the MF platform and the other one on the PMS platform. So let's suppose both managers have a view on two leading banks that feature in the top 10 universe of Nifty 50. Suppose the manager on the actively managed large cap or equity fund thinks that the price of bank A, which commands 3% weight in the benchmark, will increase more quickly compared to, let's say, bank D, which has a weight of 12% in the index over the course of next 12 months. So based on this perception, let's say the manager would buy less of bank D and buy more of bank A. And if the call is right, the fund manager will outperform the benchmark. In the case of PMS manager, if the portfolio manager, based on a similar view as the mutual fund manager, were to take actions, they may decide to completely exit bank D, which happens to have, let's say, 12% weight in the benchmark, and which may result into a much higher outperformance or much higher underperformance. So there are two key distinctions. One is the regulatory flexibility in terms of the guardrails that are available to PMS managers. Second is the approach that is used by PMS managers compared to mutual fund managers who are largely relative return products. Now, there are some challenges that we can talk about, and that's why I emphasize the word theory. What happens in actuality is a little different.
Yeah. So, okay, before I go to Kshitij then, Shantanu, you might want to elaborate on the challenges.
Okay, so first is that PMSs, they came into being with the promise of better security selection, higher returns and outperformance compared to mutual funds. However, they don't always live up to this promise. Let me talk about the reasons. The first reason is the significant difference between gross returns versus net returns. So needed gross returns are optical, whereas net returns are important since they are what we consume as investors. So the difference between gross and net returns is attributed to management fees, operating expenses, and tax expenditure. So tax expenditure has already been covered in some sense, but I'll unpack that. Typically, PMS products have higher management fees. So first, PMSs have higher fixed management charges. In some cases, there is a profit sharing clause as well, resulting in a higher total expense compared to mutual fund. And the higher cost could range from 0.5% to, let's say, 1.2%. Second, in the case of PMSs, and this is a very important difference, management fees are not deducted from the total value of investments for the purpose of tax computation, resulting in higher taxable gain for investors. Whereas in the case of equity mutual funds, the fund's total expense ratio is deducted from the fund's net asset value, resulting in a tax on net gains. That is on the net of management fee basis. So that's another area where there's lesser leakage in terms of the total taxation and management fee. The second, of course, is on taxes. PMS do poorly compared to MF, and which is a drawback. Why the difference? As was covered, equity MFs are pooled investment vehicles. They essentially invest in a broad set of securities. The end investors, they get units in exchange of investment. They don't really own the stocks, which is why the churning that happens at the fund manager's end in terms of selling and buying securities, that churning does not result into taxation in the hands of unit holders. Unlike mutual funds, a PMS isn't a pooled vehicle. Each client's portfolio is managed separately, and a PMS manager buys and sells securities using the individual investor's demat account. So therefore, the activity of buying and selling stocks are taxed in the hands of individual investor because they are conducted through the demat account of the individual investor. Again, I'll give you a quick example, and then we can move on to the next point. But let's say a PMS manager invests in a stock worth 5 lakh and which gains, let's say, and which is not unthinkable in the current context, 50% in 11 months, then sells it for, let's say, 7.5 lakhs. So the investor, and the investor ends up paying short-term capital gains tax at the rate of 20%, resulting in a tax liability of 50,000 on a gain of 2.5 lakhs. If a similar transaction was done by a mutual fund investor, there wouldn't have been any tax liability on the gain right away. Instead, the gains would have been added to the net asset value of the fund, which would have led to possibly two things: lower taxes, because as an MF investor, I will only pay tax when I sell the units. So if I decide to hold the units for 12 plus months to move to the LTCG territory, I benefit from reduced taxation, and also deferred taxes, because I may hold the units for next 3, 5, 7 years. So when the unit holder would have eventually sold the mutual fund units, then the tax liability would have been there. So that will also lead to better compounding. So this is the tax related challenge. And the third, of course, is the taxes on dividends. That's one difference. The dividends received on stocks in mutual funds are included in the fund's NAV. So that increases their tax efficiency. In the case of PMS, the received dividend is included in the investor's annual income and tax is the investor's marginal tax rate. So net, as per our calculations as a house, what we have realized is that a 30% churn or turnover by a PMS manager in a given year results in a cap gain tax leakage that leads to about 1% additional leakage from the gross returns of the PMS products, just by means of added tax liability. And when you combine this with higher management expense ratio of, let's say, 0.5% to 1%, you are staring at
Sure.
1.5% added expenses.
Yeah. No, point well taken. Actually, Kshitij, can I come to you on this? Again, difficult because you guys run a PMS too, but I'm just taking an example of somebody who ran a PMS and has become an AMC, right? And offering almost the similar product for much lower an individual ticket size or can go higher. So let's say I'm using the example of Old Bridge, right? Ran a PMS AIF, now as an AMC, and the mutual fund portfolio, you could argue, if not now, then eventually would mirror what the PMS portfolio would be, because they'll be left with an AMC. So much lower ticket size of investment possible, right? Fairly liquid in that sense, or maybe PMS would be as liquid too, but no tax leakage, something that would happen maybe in a PMS, right, in some sense. So I would love to understand, would it be the portfolio manager dependent, a dependency which will lead an investor who, let's say, has 50 lakhs to invest in, to choose between a PMS or a mutual fund? Because apples to apples as a structure, a mutual fund might be a better structure than a PMS.
Neeraj, I think one of the best questions in recent times, what you have asked, and I keep on telling many of my clients, keep on asking, why PMS, why mutual fund, what to choose between both of them. So, just to keep things in right perspective, portfolios where you have low churn, let's say you have 7-8% churn, 9% churn, there the taxation part is not that big. Second, on the expense ratio side also, mutual fund has two expense ratio. One is your fixed expense ratio for distributor, and one is your direct expense ratio. In PMS also you have two expense ratio, but at the same time, PMS is much more flexible in terms of its expense ratio. With a higher ticket size, you have a different expense ratio, and you have a plan where you have a profit sharing platform also, where you have a 0% expense ratio and only basic charges. In fact, if you ask me, as you achieve a size in PMS, your overall overheads also become very less. Third, very important, PMS is a very personalized approach portfolio. There are two types of PMS. One is your discretionary portfolio, where portfolio manager takes a call. One is a non-discretionary portfolio. Now, when I'm talking to you that when it comes to deciding between a mutual fund and a PMS, somebody who's with a lower ticket size, any day it makes sense to go with a mutual fund platform only. Any day. When you have a PMS offerer, like I'm talking about us, we have 7 to 8% churn on a yearly basis. When you PMS offerer, there are many PMS offerers which are very long term, where there's hardly any churn. So where the churn is less, and I agree with you, after the recent tax change on the equity side, it has become a little less lucrative as a mutual fund. But if you have a PMS offer where the churn is less, and there the conviction is very strong, because in mutual fund, as rightly said, that you have been capped by mutual fund regulation that says that you can't have more than 10% in a single stock. Where you have a focus approach and a PMS offer, when there's a less churn, I think PMS is capable of delivering a equal or a better return as what mutual fund or flexi cap mutual fund is doing. Having said that, there is nothing one against another. But yes, PMS is meant for people who have love for direct stock holding. As we all know, the unique demat accounts are 10 crore, the unique mutual fund folios are 5 crore. So many of the cases, what we receive at our end is through stock transfer. People who are managing their stocks, but they are not able to have right time to do it. They are not able to make the right call. They don't have the right research. They just transfer the stocks to us. So it is clearly meant for that set of people who are looking at having stocks as their personal holding, but they don't want to manage themselves. They want they want a portfolio manager to do it for them. I think PMS is meant for those guys, and that's why you see the many number of PMS offers are coming, and the love for that stock, buying stock directly, is increasing day by day. So I think one set of people who are looking at participating in PMS is those people who have affinity towards stocks and they want to buy stocks. Second is, yes, where there's a less share, it becomes much more viable for PMS to have a better return vis-a-vis low expense on the card and low tax element coming on the card.
Okay. Now, same question before we take the queries to both of you. Shantanu, here's the hypothetical situation that I'm creating. There is a lady who's come to you. She has between 50 lakhs to a crore. So she can invest in mutual funds or a PMS or even an AIF, if you will, right? All three options open. She is of a moderate risk appetite and she's got a moderate time frame, not necessarily needs the most liquid of investments as well, right? Now you have all options, and with the presumption that you probably also advise on mutual fund portfolios or a portfolio which is a basket of all, where is it that you would deploy that sum if you had the choice or if you had to choose only one, considering all the other factors? There is almost complete freedom on the timelines and the risk appetites. What would you do?
So let's chat about what viewers can avoid doing, and I'll answer that question with that as a context. So some of the things that we encourage investors to not do is not chase past performance. The second, of course, is when it comes to allocation, we do not like to over-concentrate exposure in a single instrument with a single manager. In any event, we feel that no more than 50% of the total equity portfolio should be invested in a single actively managed scheme, be it mutual fund or PMS or AIF. So that's where, I would say that with that kind of an allocation budget, both AIF and PMSs are precluded because we wouldn't want to allocate 50% of a client's corpus with a single AMC. Because despite stellar runs in performance, we've seen cyclicality in performance of the best of fund managers. And we've seen very seldom that investors persist with fund managers during their lean phases. So from concentration standpoint, both will be precluded. Now that leaves us with mutual funds. In the case of mutual funds, we will create a diversified basket. So basically, for somebody with 50 to 100 lakhs, the starting point will be to create a solid foundation of the portfolio by allocating to simple index strategies, Nifty 50, Nifty Next 50, maybe Nifty 150, mid-cap TRI, and then to build the next layer by choosing a very strong line of multi-cap managers, on the MF platform, 3 or 4 of them. Also, we are mindful of different styles, as you've seen that markets have seen significant style rotation in the last 4 years. So we will try to spread it across different styles, value, growth, contra, etc. And finally, if the investor in question is savvy enough and has seen multiple market cycles and is willing to tolerate short-term underperformance and significant drawdowns, we may also allocate to mid and small cap strategies on the MF platform. Had this ticket size overall been higher, let's say 100 would have been 500, then we would have replaced the small and mid cap mutual funds with small and mid cap PMS strategies. That would have been the change.
Okay. Kshitij, the same question to you.
So,
and you're not allowed to recommend complete circle PMS. So that's the caveat.
Right. So, I'm not recommending anything here. All I'm saying is if 1 year is the only amount which she has as we speak, and there is nothing else, then I think mutual fund is the way which she should approach. Whether it's any multi-cap, because
Kshitij, sorry, let me interrupt. Let's assume that is also not a constraint. I'm saying all options open, then what is the instrument?
Okay, it's 1 year is the amount, and which is like an add-on amount which she is getting into. Still, I will say that 50 lakhs should go into any PMS, whatever PMS she likes, and it should be a multi-cap PMS. And 50 lakhs should go through a staggered manner in a mutual fund, let's say 3 to 4 schemes or 5 schemes. No, so normally, many of the PMS now, what they started doing, we've been doing since inception, that you should stagger your investment in PMS also, because markets are in no rush to go anywhere and keep on getting your time and right price also. But at the same time, you should stagger your investment in mutual fund and PMS. 50 lakhs should go into PMS and 50 lakhs should go into three or four mutual fund. That way you diversify. You have some stock portfolio also going to you, and you have a mutual fund portfolio also. Now, the beauty of PMS is, Neeraj, as I said in my last reply, you can transfer your stock. Tomorrow, for some reason, you don't like the style of a fund manager or you don't want to continue with the PMS, uh, like in mutual fund, you can redeem your stuff. In PMS, you can either redeem or you can take back stocks also. If like it's a good portfolio, you say, no, I won't continue and I want to manage my things myself for whatever reason, then you can take back the stocks also. So I'm saying, so that is something is a, because, believe me that the number says itself that the cult of direct investing into equities will keep on going up day by day, vis-a-vis the managed portfolio, and we can see the double the numbers of unique demat account holders. So you will see that cult increasing only, and that will help many people. And being a professional manager, any of the good guys, I'm not talking about us, any of the guy who's managing, doing a good job, I think is the right way to approach. 50% PMS, 50% for mutual funds or STP route over next 6 to 8 weeks.
Okay. Now, gentlemen, I'm going to bring in some queries from viewers, because this is what a lot of people really want to know. You may or may not be able to recommend specific funds, but they could be just examples, need not necessarily be an exhaustive list as well. So the first question is from Dipankar Das. Dipankar is age 35. Dipankar says, what are some of the best thematic funds that can be invested in? I'm looking to add more exposure to thematic funds as part of the satellite portfolio. Now, Dipankar, we just interestingly had a conversation today with Rajiv Thakkar of PPFAs, who decried this whole thematic fund investment notion. But be that as it may, there are some people who like it. And I like the fact that Dipankar is clear that he wants to add these to the satellite portfolio. Shantanu, do you have any thoughts?
So the first thought is, when it comes to themes, what's important for investors to realize is that themes are always driven by some fundamental assumptions. And as important it is to track the performance of the fund that is playing a particular theme, it's also important to track whether the assumptions that are driving the higher growth in a particular theme stay relevant for the course of investment. So let me give you an example. So for instance, we have seen off late manufacturing as a theme being played a lot. Now, for manufacturing as a theme to remain relevant for next 5 to 10 years, and thematic is different from tactical allocation. You can't take a 18 to 24 months view. If you're taking a 5 to 10 year view, so we need to understand what are the key drivers of the theme, and one of the drivers is policy continuity. So basically, if let's say there's change in policy continuity, then all of a sudden the theme is not as attractive. So I would suggest Dipankar that if he's working with a financial advisor who can, in addition to identifying the right fund, also track the underlying drivers of the theme and decay on those drivers, then he should go ahead and play a particular theme, and themes can be manufacturing. A lot of themes are not available on the public market side, the promising ones like renewables and all. But manufacturing does look promising, but I'm just saying that, it has to be done with the help of the financial advisor who will not only take ownership of the fund's performance in a way, but also track whether the theme stays relevant for the course of the investment for next 5 to 7 years.
Kshitij, you have a different advice? Any funds that you can think of, thematics which you believe are safe or good to do?
So very much in line with what Shantanu has said, theme can't be tactical, and as government is pressing hard that we should have 25% allocation coming from manufacturing by 2030 in GDP contribution. I think manufacturing has become more of a evergreen thing, what we used to talk about FMCG and banking. So I think in themes, I think manufacturing is one. Defense is another, but I think still valuations are not that much in a comfort zone. But yes, one can look at ICICI Manufacturing Fund and couple of more manufacturing fund where many of the AMCs are offering that. So, and moreover, you should not have more than 10-15% of, maybe 10%, 15% is also a little higher. When you buy a flexi cap or multi cap fund also, neither you get allocation toward these type of sectors otherwise also. So I think individual, when you want to approach a theme, then I think just approach a theme which can create a delta vis-a-vis your flexi cap or multi cap fund. Then I think clearly manufacturing stands out in that scheme of thing.
Okay, I have less than 60 seconds. I'm going to try and squeeze in one more query. Nirmal at the age of 55 is asking, is looking to invest about 60 lakh as a lump sum amount. Do we have the time, my producers, to ask this query? Okay, we have a minute. Okay, 60 lakhs lump sum. Is this a good time to make that investment? Kshitij, very quickly, 30 seconds.
I think multi-asset fund is the right time rather than just staggering it. His age is 55, and he will gain from rate cut on the fixed income side as well as gold movement as well as equity at 11% discount from the peak. I think multi-asset is the right way to invest.
Okay, so if you want to do lump sum multi-asset, Shantanu, is lump sum a good idea, or at the current state staggering it out is a better idea?
See, given
20
the
seconds,
information,
Shantanu.
yeah. So a hybrid fund for sure, and a dynamic asset allocation fund. So something like a balanced advantage fund is something that I'll recommend at this point in time, or a multi-asset fund. But the preference will be a dynamic asset allocation fund where the equity weight can be managed based on valuations.
Okay, but lump sum, Nirmal, is okay with both our guests, and that's interesting to know. Thank you so much, both of you, for joining us on the show and giving us your thoughts. Really appreciate your time.
Thank you so much for having me on the show. It was a pleasure speaking with you.
Yep, likewise, both of you, and gentlemen and viewers, thanks for tuning into this edition of the Mutual Fund Show.